Today on Around the Coin podcast, my guest is Ruben Galindo Steckel, and he is the CEO of AirTM. AirTM is a leading online platform that provides financial services to users across the world, really focused on freelancers and enterprises using Web3 technology to facilitate payments to make them cheaper, faster, and easier. I talked to Ruben about the landscape of payments in the Global South, what the Global South is, what the future of the USD looks like, how cryptocurrency and USDC start to present emerging opportunities for crypto to be more competitive with USD, and some of the psychological decisions for product managers who are thinking about building in different payment systems into their gateways or into their services like Twitter. So for all that and more, please check out Around the Coin podcast, aroundthecoin.com. Give us a thumbs up, like, share, subscribe wherever you listen. And here is Ruben. All right, Ruben, I'm really excited to be chatting with you. Thanks for hopping on. I know you had an adventurous route to get to this podcast now, so I appreciate it. Why don't we kick it off with just a brief overview of what you're working on and how you sort of see the landscape of financial technology internationally today, what the most topical parts of that are?
That's a big question. First, thanks for having me. I'm excited to be here. So I guess I'll start with what we do at AirTM. We help people participate in the global economy throughout the developing world. And I guess even if it's not so developing, it's a challenge for people to understand that they can go make money online. It's not the main thing that we do. We try to go find a job and we go do that in the street. And even though that's changing rapidly and you already have more than, I think, 400 million freelancers around the world, there's still a lot of people in the need of a job for whatever reason. Maybe there's not a job locally, or maybe they hate what's available locally. And we try to bring that global economy closer to the people that we think need it the most. These people throughout the global South, and Latin America, or South Asia, wherever they might be, Africa. And the way that we do that is that we give them this dollar account, which is like your base retail product. It's called the AirTM dollar account. And you can use it to collect payments from abroad. Not just that, whenever you do receive a payment from abroad, AirTM has a very unique way of allowing you to withdraw money locally. And so in essence, you could think of AirTM's retail wallet as the best way to receive a payment internationally if you live in the global South and you need to cash out, because you need to eat with the money that you make. And so best I'll describe as the cost, the speed, and the diversity of payment methods that you can cash out to. So AirTM is, we believe, the most diverse, the cheapest, and the quickest. And so that's why I think it's the best. It'll take you 6 minutes and you can cash out for 40 cents and 2% to basically any local payment method throughout the global South, which is not something that's very common. And so that's one part. The other part, which kind of ties this, or it brings the concept home about helping people join the global economy, is that we also actually help enterprises that provide online jobs, any type of online jobs, access to paying these people through our mass payment products. And so if you are familiar with PayPal mass cross-border payment services, you know that they have a variety of ways for you as an enterprise or as an individual to distribute payments to people throughout the world or to their PayPal accounts. And then the reason why, again, AirTM has this claim at being better than PayPal in this case, is because we can allow retail users that receive a payment to cash out cheaper, quicker, and to more payment methods. As far as the enterprise side, well, it's a challenge convincing these enterprises, hey, our solution is better for the people that you're paying. And so that's kind of where we are. However, AirTM is a Web3 company. And as a Web3 company, we are kind of caught in between the old financial system and the new one. And I know you're asking or wanting to ask me questions, but I just want to bring it home and then I'll shut up. The reason why I say we're caught is that PayPal and the tellers, real pioneer big mass cross-border payment incumbents or digital wallet incumbents, all multi-billion-dollar businesses, they have priced cross-border payments. So in the industry, you know that a cross-border payment for an enterprise, you can charge 2% for it. Why would you not charge 2% for a cross-border payment? However, we as a Web3 company know that payments happen peer-to-peer. So directly between enterprises and retail consumers. And so why should we not charge that 2%? Yeah, it's free. It's happening peer-to-peer, but it's valued at 2%. So are we going to leave that money on the table? So that's where we're caught. And so we're constantly grappling with this dichotomy of Web 2 versus Web 3 and the benefits of each. And so I think that where we're headed is finally accepting that AirTM is a Web 3 payments company and acting a bit more like so, which means, okay, payments are going to happen peer-to-peer. Let's give enterprises the software they need to deliver peer-to-peer payment methods. Let's give them a great way to receive that payment or to refer that payment to. And we could generate value there because we are actually generating value to the consumer when they're cashing out and our rails are better. But truly to the enterprise world, I think we gotta, and it'll be important for us because I think that is the next frontier in cross-border payments is that they happen peer-to-peer. And so I think we will be pushing more on that direction. And then the last piece, which I'll talk about helping people join the digital economy, is that we bring our digital entrepreneurs, that's what we call people that work online, and their places of online work together in this community where they interact with each other. They offer jobs or they take jobs from the other. And we also offer a wide variety of services for the digital entrepreneur. It feels kind of AirTM, in a nutshell.
Mm-hmm. So you're split across business and individual or retail. So you sound like you're targeting an enterprise or larger customers and then smaller. Is the underlying infrastructure that allows you to make these claims of being better, faster, cheaper, is that due to the blockchain technology compared to the typical banking rails? I mean, ultimately, that's the technological innovation that you're exploiting and putting a layer on top of. Is that the right way to think about it?
Sure. So I guess in my mind, there's like four main pieces to our cross-border payment solution. And you maybe can generalize it and say to others in the crypto space. You have your liquidity providers that allow you to onboard and offboard from the asset. In our case,
that would be like banks.
It depends. It depends on the country. It might be an exchange. It might be literally a crypto liquidity provider. It might, like MoonPay, it might be a bank. It's banking you as a company. It might be Circle or Coinbase institutional. Anyway, you need to give your users the ability to deposit and withdraw. So we call that just providing liquidity. Because you give them dollars, they give you some sort of crypto asset. Then there's a crypto asset layer, which is like the asset that's used as a store of value, as a way of transferring value amongst your community. So then there's the wallet where the asset's kept, and then there's the blockchain. So those are AirTM's four main layers, if you will. And we kind of have decided to focus on this one and this one. we focus on the liquidity, providing liquidity, because we believe that having the best rails will be a key differentiator in the future and is a great way for us to derive value from what we do, which is delivering cross-border payments. We delegate the asset side of this to Circle and Coinbase and Center because we leverage this thing called USDC, which everyone knows. That is the asset that people have in their wallets and that moves around. We own the wallet, obviously. That's the other, I guess, the two things that we own, the liquidity and the wallet. The wallet because we want to be consumer facing. We want to be people's place of international business. We want to be your account to do business online, to receive payments, to pay things, to buy things, to do to solve all of your, I guess, global economy financial needs, if you will. And then lastly, the blockchain, which we decided not to build ourselves. We use Stellars because they allow for very cheap USDC transfers, essentially. We like their team, and they also are very well connected to a lot of liquidity providers. So that allows AirTM not to have to develop relationships because land has been grabbed or the frontier has been pushed forward by the Stellar community and the USDC community organically, or not organically, but from our perspective, without us having to have an active effort to expand into a country. And so that's why that's how we break it down. And so going back to your question, it's like, well, what's a stack, or how do we make these payments in Web3 happen, is that we give enterprises and retail consumers a wallet where they can hold their own USDC and send USDC to each other's wallets on the Stellar blockchain. And then on the ends of this, we either are ourselves liquidity providers or work with other liquidity providers to allow our enterprises to onboard or offboard, or our retail consumers to onboard and offboard.
Awesome. When you say Global South, what are you referring to?
I guess countries that are below the equator, they tend to be more distressed than the countries that are north of it. I guess Mexico is not necessarily south of the equator, and it still struggles. So that's not always true. And there's a whole bunch of countries in the Middle East that are in the same situation. But anyway, sometimes I sub in developing world, emerging world, global south.
Would it be fair to say any location that struggles with an efficient, trustworthy banking system?
No. Don't make it about the banking system. Come on. It's about access to jobs. It's about giving people the opportunity to work online. It's about helping the people that need alternatives, access to them, access to opportunity. And well, for one reason or another, I'm happy to talk about that. If you live in the EU and you're a freelancer, it's very easy for you to receive a payment. There's no innovation there. There's no issue there. Your payment system, the world's payment system, works for you. But if you live in Pakistan, it's not the case. It's not very easy for you to receive a payment. Or if you live in the Philippines, or if you live in Mexico or Venezuela or Argentina or Colombia or Bangladesh. And so in these countries, there's a lot of people that work online, and still they use payment methods that were not meant for them. They're meant for that European person that we talked about before. And so what that means is that you have to pay very high fees. It's very slow to withdraw, and you can kind of only withdraw to your bank, or sometimes you even receive a check, a paper check.
And why would you say that that's not a payment or banking system flaw? Because that's sort of how it seems like
I'd say it's not the unbanked. It's the people, because that's a category of people. There's a category of people in the world that don't have a bank.
Right.
We're not trying to service these people in particular. We're trying to service people who want to work online.
Okay. And people want to work online and don't have access to like PayPal or Payoneer or those kind of things.
Exactly, to an online payment service provider that works for them, is meant for them specifically.
And the reason why, is there limited, like why would some of these larger payment companies like PayPal, et cetera, when they're not in a country, or even if they are in a country, but they're very slow or expensive, is that typically due to regulatory blockades that are in place that make it really challenging for these larger payment companies? Or is there more of a tactical challenge where it's like the technology is not there? Like, what do you see as the reason why we don't have a more efficient payment system globally today from some of the larger providers that have been in the space?
Well, because everything costs money. Building rails costs money. And there's markets that are not worth the money that they cost. Okay. Because at the end of the day, regulation, compliance, banking relationships, FX exposure, it comes down to cost. Like, how much is it going to cost me to allow Mike in Sudan to withdraw $10? going to cost me 15. Well, do I want to allow Mike in Sudan to offboard $10? No. So why would I, as PayPal, work to build the very costly infrastructure that we would need as PayPal company to be able to allow Mike to withdraw $10 in Sudan? Screw that. We'll work with partners, or we'll send them checks. And Sudan, I don't know exactly what their rails look like in Sudan, but I'm willing to bet they're not looking amazing. And so that's it. That's it. At the same time, we believe, and we're talking about the future here, we believe that the global economy is going to flourish, that the global digital economy is going to flourish in a lot of these countries that have not been able to succeed in the past, because we're all just waiting around. And I'm including myself as a Mexican person. We're always just waiting around for a government to like figure its shit out. We're waiting for them to be like, okay, well, here's your job, or here's your healthcare, here's your education, or here's your food stamp. All these entitlement programs kind of keep us there. At the same time, we have in Mexico about 12 million migrants in the US. So that shows you, like, yeah, a lot of people are like waiting or sitting around, but a whole bunch of other people are like willing to do whatever it takes. And so we believe that it's not even when the next, it is already here. There's people that have different alternatives. I need to eat. I need to find a job. How am I going to find it? I'll leave my country. I'll go for what's available here, or I'll go online. And we want to help that third version of the person to succeed online. And we believe that that's going to play a huge part in the future. And you have examples of how much the global economy is going to be growing. Just in your Twitter feed. Last week, you saw how Twitter decided to start paying people who tweet and who generate revenue for Twitter. It's a new online job. How many people are going to receive money? Millions. It's a lot of people. Because it's not, and there's another misconception that you need to make a lot of money to earn money online. It's not true.
Right.
Throughout Latin America, for instance, I think to belong to the middle class, the median income is, I think, $14.
$14 for what? Per hour?
Per day. $14 per day. And you'll be considered a part of the middle class in your country, in your median Latin country. Which is crazy. There's a ton of ways to make $14 every day online, right? Like, I don't know, the Mike influencer on Twitter. And I don't know their parameters, but if they wanted to, they could pay. And there could be this person that be very happily tweeting all day for $14 a day. And then you also saw that very weird new online gig of people kind of talking to their emoji, or like,
Yeah. So let me ask you. So if somebody,
get another one.
Yeah, I saw a meme of it. If somebody's on Twitter in Venezuela, some country that has a more difficult banking rails, and they're using PayPal, I believe, to do payouts. Twitter is Twitter sitting around behind the scenes and saying, "Oh, we would love to be able to pay all these people in these 50 other countries, but the payment rails are so challenging that it makes it difficult." So there's all this unrealized value creation and extraction from the ability to pay the creators on Twitter. Is that the reality of it today, or do you see do you see that as a recognized problem that these companies, like, I imagine Twitter is just one of many, or Fiverr's in that category, or
I would definitely think that that's a big problem for them, like being able to, I guess, going to the platform context.
Yeah.
Right? You have platform/marketplace, you have supply and you have demand. And you want to pay your supply. You want to, because that's how you incentivize them to generate value for the demand of your platform. And so I'd imagine that paying them is like crucial. And in fact, most big companies, from TopTal to Fiverr to Twitch, they kind of solve that problem very early on. PayPal helped them solve it. And PayPal, in theory, does have global coverage. Like, you can deliver money via PayPal. It's just, is it amazing? I don't think so. But they can do the job. And so I don't think it's an interesting situation the market's in, because on one side you have rails that are providing coverage that's spotty for places where these platforms, I believe, aspire to growing. Obviously, the US is like everyone's biggest market, and the rest are like the 80% that generate the 20% of the value type of thing. But they're growing a lot. All these emerging economies are emerging for a reason, and they're coming online. And they are online. Screwler, they're coming online. They are online, and they are the platforms, and they are generating content, and they are on the supply. So I would imagine that paying them is a very important thing. And I guess our job, literally my job, is to be having conversations with the people that work at these platforms. It's usually a product manager that's in charge of payments, and they understand payments A to Z, but it's basically the incumbents, PayPal, Natello, Skrill, Payoneer, because they've been around for quite some time. And we're just having these conversations, and we're thinking about how to price it, and we're iterating on that, and we're thinking about how to present it, and iterating on that. And it's a challenge for sure. I will say that, and I guess going back to the second little point that I was making about the future of Web3 payments, we are incentivized or disincentivized to sell our rails as peer-to-peer, because there's a fee that's monetized and standard, and it's priced in by the market that they will pay. It's like 2%. And who doesn't want 2% of $100 million that you're paying out? Because these payments you're paying out a lot of money. It's a transactional business. But on the other side, I believe the new frontier in cross-border payments is when they happen peer-to-peer. When enterprises don't need to go through a rent-seeking middleman to pay people, or they can just do it as, I guess, as easy as sending an email.
Let me just clarify something. So when you are having these conversations with product managers that are focused on the payment aspect of the marketplace companies like Twitter, Fiverr, et cetera, I imagine there's multiple considerations that they have: the number of countries that the network reaches, the price, the lag time, fraud, whatever their considerations are. Is it a recognition that they want to move? Is Web3 part of the desirable feature set, or is that just a like, okay, no big deal? Like, why does that matter to me type conversation? I mean, I can't imagine Twitter or anybody thinking, I want to move to a Web3 payment transfer network because it's cool, right? It's always boils back down to the features and why that's useful. And why I asked that question is, do you see the way it is now, PayPal, Skrill, et cetera? Are they just going to kind of keep growing and sort of, it'll just be this way 10 years from now? Or do you sort of see the inevitability of an underlying infrastructure, blockchain, becoming the global payments? Maybe there's more than one, but the global payments technology infrastructure.
I guess going back to the first point, it is not people that are these product managers saying, "Oh, I'm dying to have blockchain payments." And if so, which there is that case of people wanting to deliver cash outs in, like, say, Bitcoin, like, "Oh, we're paying out in Bitcoin." They're kind of missing the point, because the cool thing about blockchain is not the crypto assets. It's the idea of disintermediating the middleman, of being able to do the payment yourself, business to consumer, without PayPal. And that is truly transformational. If you think about it, every single payment that you've made or that you've received travels through PayPal's rails. So PayPal gets to take a little bit here, a little bit there, a little bit there.
And they could cut it, and they could stop it.
Kind of. But now they have this infrastructure. And so the way I see it is that we are in a point in time where there's going to be like two diverging paths. We're going to have, blockchain opened up a new path, a fork in the road, if you will. But I think on one side, you have payment companies that have built a very costly infrastructure. And like, they built highways for money to take money from here or from the US to Brazil. And PayPal has a huge operation in Brazil and a huge operation in Mexico. Why would they not charge for the highway that they built? They're going to squeeze every single cent they can. Because why wouldn't they? I would do the same thing. And yeah, if it's a price thing, the big player can always drive prices down because to them, it's probably all margin, right? But at the same time, the fork on the road is, okay, well, what happens when you could do your own payments and the highway for money is free? It's like decentralized, democratic, and you can just participate on it. If you have the technology, it could just be a thing that you do in-house, like distribute payments. And so I think that that's a radically different way of thinking about your payment problem. And it does present this fork. And when I think about this, I'm like, I don't think that PayPal will want to say, hey, it's the innovators who I don't think they're going to want to disrupt themselves. I don't think they're going to want to go back on all the investment they already made because they're so bullish on it. They spent billions of dollars building it. And so for us, nimble companies, like, hell yeah, I want to build on that next frontier. However, we are selling products to the same client. And so we have the challenge of presenting our version of how we believe cross-border payments should happen. And so the way that these product managers should be thinking about it is, first of all, let go of all the money you lost
for what?
Trading crypto.
Okay, sure.
You're not taking crypto risk. This is something else. Because we get that question. Are we exposing ourselves to crypto risk? And I'm like, no, separate thing, but equal. It is a crypto asset, but we will use it. We will help you use it to deliver a payment to someone directly. And so it's like, well, how can I leverage this to have to stop paying a middleman for doing something that's now free? And look, some of our clients might hear this conversation we're having, and they'll be like, damn, you're charging me. And yeah, because we're caught in the middle, because the market charges for this, and we are cheaper than PayPal. Because we're like, okay, they charge you 2, we'll charge you 1.5, or we'll charge you 1%. But that is disincentivizing us from doing the other thing, which is what we are truly excited about doing, which is building Web3 Rails, Web3 PayPal. You get where I'm caught in the middle?
I want to understand pricing a little bit more. So when we talk about pricing, the difference between Web 2 and Web 3, what we're saying is the cost between the banking rails, and the banking rails being the number of network connections between payment providers. And there may be 2, 3, 4 different banks that are intermediaries between a recipient and a sending bank, and each one takes a fee. When we aggregate all that price up, maybe it's 1.5% or 2%. If you look at the comparative costs of making a direct network transaction on like Stellar or Bitcoin, are we talking about a 5x or a 10x? Like, what's the order of magnitude pricing differential? And do you see the price being the primary driver of adoption to Web3? Like the product manager is going to get pressure from the head of finance, like, hey, we really want to reduce costs here. And so they're going to start shifting over. Like, does price drive innovation effectively at the enterprise level?
I think innovation is what drives consumer choice. And there might be a bunch of different reasons why the innovation is better. Price definitely being one of those things. And I guess something I did forget to mention is that all these enterprises are big companies. A lot of them are big companies, and they have a very sophisticated need, which our enterprise solution might not entirely meet just yet. And so we are committing to enterprise to build out product features that they need to feel comfortable using our solution. It's kind of bare bones what we have. And if you see PayPal's enterprise dashboard, it has all the bells and whistles. And so we're also having to compete against that. So that's also a barrier of adoption for this product. So we're constantly building on that precise thing, because you got to be able to peel the orange to get to the juicy part. But the peel is also very important.
Sure.
And so I guess in terms of the pricing difference, I guess first it's important to know in a digital payment, there's not like 5 middlemen. PayPal is fully integrated from the US to Brazil. Like
Okay.
they use their own infrastructure end to end. And same from the US to Mexico. And they have a lot of countries where they are fully vertically integrated and they own the whole corridor. There's not 5 middlemen. It's not like a bank transfer or a SWIFT where you have banks providing liquidity for each other around the world and they're having to borrow money from the other so they can pay out a payment. And that doesn't necessarily happen with electronic payments. It's more like either the payment company at PayPal has this is built end to end and they leverage, they're able to kind of take money from the US and deliver in Mexico or cash it out when the person wants to withdraw. Or maybe they don't have a presence in the country where the money is being delivered and they need to work with a partner. So for instance, we work with our dear partner Payoneer, which is a big wallet, to deliver payments for them throughout LATAM because we have very good coverage throughout LATAM and they want to expand throughout LATAM. So we're like, we'll help you deliver those payments to the people that you need to so that you can expand throughout LATAM. And so that's the other way it happens. They insert the middleman so they can fulfill a payment. And so I guess, and these might vary, but when I'm explaining PayPal's fees at a high level, I kind of talk about different sixes. It usually costs $6 fixed fee. Charges, you lose 6% of your money and it takes 6 days to arrive.
6%?
So
on PayPal?
It's crazy because you're getting charged a variable fee when you're withdrawing from, say, your freelancer.com wallet or when freelancer's paying you. Then you get charged when and there's also a fixed fee there, but it's smaller. Yesterday I was looking at PayPal's fees. It was something like for payouts to the rest of the world, it was 2% up to $20 plus 50 cents to withdraw from your Twitch account to your PayPal account. And then assuming that you're in Argentina and you want to cash out PayPal, then you have to pay the local exchange rate.
So really anytime
ends up being that. And so
anytime you move between networks.
Anytime you move between countries. Between, I guess, money pools. You're going from the American money pool to the Argentinian money pool, like costs, because you need to source liquidity in both places.
So this would be true to say that the pricing efficiency of staying in the same payment network is going to drive like a consolidation. Like this is why we have a global currency in the first place, is that it's just simpler to maintain fixed pricing, easier to move money around, cheaper to move money around.
Well, yeah, the US dollar builds something super cool, which is everyone's willing to settle with dollars, right? Like everyone everywhere, and price themselves in dollars. So you could basically buy anything in dollars anywhere, which is super cool. It just so happens that it's not so simple. And I think that to actually send dollars to someone else, because it's like, unless they have a bank account in your banking system, then you can't send them dollars. And if the case is that you can send them dollars because they have the HSBC multi-currency account in Hong Kong, sure, maybe you can send them dollars, but it's not a straightforward thing. However, USDC makes that quite easy. They are an open dollar standard that is democratic and accessible by anyone, and it doesn't take a very sophisticated and expensive HSBC multi-currency account to have. You know, you in Nigeria could receive a dollar payment without having to have the very expensive HSBC account.
Right.
And also, the USDC ecosystem is like, oh my God, it is the frontiers of USDC are being pushed by every single exchange in every single country, which is so powerful. That means that there's a Ruben basically in 196 countries that is working very hard to make it such that USDC is compatible with their local currency and vice versa. and at a good exchange rate, or with small spreads. And so that makes it such that every other entrepreneur, every other Ruben is like more incentivized of being on the USDC network because it's connected everywhere, or it will be connected everywhere.
Wait,
If there
let me
was
just
one
make,
company,
I just want
yeah,
to make sure I understand that. So you're saying that countries across the world are incentivized and actively working towards building an efficient, call it transfer network from their local currency to USDC, so their citizenry can move from their local currency to USDC. Is that the right way to recap what you
no,
said? Okay.
I'm saying almost, but the difference is not the country that's trying to do this. In fact, it's probably the country trying not to do this very
Right, trying to
hard.
stop it. Okay.
Well, in some cases, trying very hard to stop it. But in most cases, there's an entrepreneur locally that wants to make their money more compatible with the world,
I
or
see.
to
To
give
get,
their people
yeah,
access to
yeah.
crypto or whatever.
Right. Okay.
And USDC is like the one.
The gateway
It's like
drug.
it's the very regulated,
Hmm.
very user friendly because people are familiar with the dollar and they all love the dollar. It is the asset in my mind. It
Yeah.
is the stable coin. And
Hmm.
so for me, another entrepreneur all the way around the world, it's more likely for me to adopt that USDC standard,
Right.
just the crypto dollar standard, than any other, because I know there's entrepreneurs everywhere fighting to get the USDC connected everywhere.
Right.
And so our wallet users, because all the other entrepreneurs are going to be able to withdraw very quickly. Like, for instance, I'll give you an example. I get paid in AirTM. We lost our ACH rails like a month ago because a partner that we used, they ceased to exist. And we're integrating a new one, but we have this gap. For 2 months, we're not going to be able to process your withdrawal to the US. It's not a big market for us because we're paying out people throughout Latin America and the emerging worlds.
Hmm.
But for me, an American dude who lives in New York, I need to eat and I want to withdraw. So what I did is I withdrew from USDC. From my ATM, I withdrew USDC and I sent it to my Coinbase account. That was immediate, literally immediate. And then Coinbase, for a price, has immediate withdrawals to your bank.
Hmm.
Because Brian Armstrong worked really hard
I
to
see.
make
Yeah.
USDC super compatible to the American banking system.
Yeah.
So that way, me, the Mexican dude living in the US that got paid in USDC, could withdraw to his bank literally as I was waiting to take off in like 3 minutes. And I paid my credit card.
Yeah. I love it. So I have a couple yes or no questions for you. Do you agree that the U.S. three-letter agencies, in particular the SEC, we'll start with that one. The monetary governmental regulatory agencies in the U.S. are actively trying to disallow the flourishing of cryptocurrency related technology products in the US?
Yes or no? Come on.
Or it
I
could be a
think it's a
maybe. I mean,
nuance.
yeah.
Maybe. I think it's more nuanced. I don't think that the
Mm.
US, I think that this Operation Choke Point is very, I wouldn't even say it's like very conspirational, but I'd say it's like, it's kind of naive
Hmm.
to say that the bank, the central bank wants to make the US dollar just by the push of a button worse than something else. I think the US dollar wants to remain the most accepted, the best currency ever. And
Sure.
to do that, you kind of by default cannot restrict it because by default, and every economist knows if there's a better currency, well, you don't want there to be a market where there's a better currency than yours. That creates, well, it drives the price of your currency down, right? Because there's people wanting the other currency.
Mm.
Sometimes markets get so crazy, this little preference and the belief that because there's so many more people wanting the better currency over the worst currency, it pushes hyperinflationary spirals. That's like a very known thing. And I don't think that the US is looking at crypto. If they are thinking, oh, crypto is a better alternative or stablecoin is a better alternative to the dollar and thinking, oh, we definitely want to make the US dollar worse than this. I don't think they want to push the US into a country where there's black markets of other currencies. And so I think sure, they're trying to control it. And let me tell you, we lost Silicon Valley Bank, we lost Evolve Bank, we lost Signature Bank. I think when the big Silicon Valley Bank thing happened, all crypto banks, they died like in one weekend. And AirTM was super effective because that was our way to get offboarding and onboarding. And I still don't think that it was a very deliberate action to like shut the US economy out of crypto. Is there a part of me that wants to believe that? Yeah, for sure. Because my God, the US dollar is in this inflation path and they can't restrain it, and the interest rate is going way up. And of course, they don't want to allow people to have an easy way out of the dollar. But even that is like silly because the crypto market is not that big. It's like we kind of get lost in that, in our echo chamber in Twitter, I think.
So that maybe the idea that crypto is the alternative to USD and that the government may look at crypto as being the exit ramp, maybe that's overblown, you're saying, and it's not that hard to move out of USD if people wanted to. So do you see some other incentive, or do you see some, like, how do you rationalize the apparent desire to extinguish or diminish at least innovation in the US? I mean, certainly to your first point, to preserve the power of the USD, you have to, or you'd be incentivized to diminish the power of competitors, just like in any marketplace, right? And so there's some logic there.
I see something different. I'd say you want your currency to be second to none. And in my mind, what makes your currency second to none is if you restrict it. Because if you restrict it, you create parallel markets. Like, for instance, in Venezuela, they restricted people from buying dollars. And so guess what? People didn't stop buying dollars. They just did it away from the government's purview.
Yeah.
So you don't want that. And so I don't think that the US is going to push consumers to have to buy crypto in a parallel market.
Right.
So I don't think that, I think that's disincentive to do the thing that you're saying, which is if they actually were worried that crypto was better, then the last thing you'd want to do is restrict people from buying it, because all people would do is to abstract themselves from the regular economy and get access to crypto and parallel markets. So that's kind of what I'm saying. And also, I guess and I'm not an American guy. I did live in New York and I do have my green card, which I love dearly, but I'm a Mexican guy. And so I'm not super up to speed with what Senator Warren and Gary Gensler are doing to like kind of kill crypto. And I share all in podcasts like religiously. So I'm aware of what's supposedly going on. And I don't know. I think that definitely if there's probably people that could say that these two are conspiring against it. Sure. Okay, fine. Is the US central bank going to push American consumers to a black market so they can fulfill their consumer desire for crypto? I don't think so.
Do you think the USD is the global reserve currency 10 years from now?
Yeah,
largest?
I do think so. Well, we're super bullish on the dollar.
Yeah. We as an
We
AirTM?
are super bullish on the dollar. In AirTM, yeah.
And is that because of
look,
USDC?
No, it's because of the dollar.
Okay.
The USDC is because of the dollar. That's why USDC is so important. It's because of the dollar. My God, for way too long has the dollar been around, building or branding itself as the currency in the world. You go everywhere and the dollar is king. And yeah, I know that empires do fall. And I know that world reserve currencies have kind of changed from in cycles, but I do not believe that there's any competitor Like I'd see myself as a individual more likely to save in dollars and in Bitcoin. Like even being a crypto enthusiast, I have a daughter. I truly want to be able to count on my savings to pay for things if things go bad. I don't want to I don't want to gamble with that. It's like, I want dollars or maybe gold, but gold is not so liquid and it's not safe to have gold around. So dollars in my bank account, I think, are my best bet. Chinese currency, well, I don't know.
Yeah.
Far away, China. How do you get that? It's like,
Yeah.
a lot of things would have to happen. I think it's like we simplify the how we would get there part.
And is the calculus you're running in your mind when you think about the risks of the two different currencies of BTC and USD? Do you think USD, the risks are inflation through runaway printing, specifically the Federal Reserve printing to pay off the debts that it has? And then maybe down the BTC side, the risk is federal level or even state level USD banning or sanctioning under the threat of a military force. I mean, is that the two, or are there other levers that weigh into your calculus when you say this is what you're placing your bets on now?
Well, I'd say the dollar is less of a bet than Bitcoin. I'd say Bitcoin is a bet. Like it's a huge bet. I love that bet. I'll take it any day, but it's a bet. Like one cannot live comfortably
It's
with
a higher risk
Bitcoin
asset class.
savings.
Yeah.
Yeah. It's like super volatile. Like it would not surprise me for in a second, would not be like, oh wow, if Bitcoin dropped to $15,000 tomorrow. So would I want to have my savings in Bitcoin? No. I have an investment in Bitcoin for sure. I invest a lot of money in Bitcoin. That's not my savings. And look, all the things that restrict Bitcoin, I think make it more powerful because they just prove its reason for existence. And so I'm not worried that that's the risk for crypto. I think that encourages Satoshi's mission. And as far as the US dollar, runaway inflation, look, I think the guy Jerome Powell is doing a great job of managing inflation. Little by little, it seems like inflation's decreasing. Americans have not stopped buying anything. There's also record low unemployment rates. So it seems to be doing fine. What I think is crazy for Americans, and this is just criticism, friendly criticism, that Americans will buy anything. There's literally no stopping the consumer desire that an American has. Like I lived in New York throughout this process. My coffee got to cost and a chocolate croissant got to cost $11. Like why? Well, fuck it. Am I going to pay $11 for a chocolate croissant and a coffee? And on top of that, they ask you for a 20% tip.
Yeah.
Like, who in their right mind buys that?
And so you did?
Buy that. Americans buy that. Sometimes, no, sometimes I would say, no, I don't want to buy this. It's too expensive.
Yeah. Well, I'm always fascinated by like the things that seem the easiest to take for granted are the ones that are the highest risk for flipping. It's like you'd almost have the assumption, well, New York is the best place to live because it has the highest earning potential. But then when you move there, you realize, well, the taxes are the highest out of any state in the country and it's the most competitive. And then all of a sudden it loses. San Francisco is probably a better example because you move there for the opportunity and then it flips. And like the flipping can be really quick and can make something that you take for granted all of a sudden seem like a really high risk classification. So like real estate in San Francisco, oh, it's the absolute best. So when something seems like you take it for granted, like the price of a cryptocurrency or the price of real estate or the price of the stability of USD, that I have this like intuition that I've seen now where maybe that's the point at which it's the highest risk. And I don't know. I mean, food for thought, but it does to me seem like a bet. Like it's certainly a bet to hold USD. It's a bet to hold anything. When I say a bet, it just means a decision that you're weighing the risk portfolio of that decision. And explaining it is the risk of BTC, particularly the volatility, which seems to be definitely true today. But then like there's a certain risk in USD, right? We're recognizing that, talking about it, trying to figure it out. Yeah.
But don't you think that do you see that risk? That is like the risk is that there's people that are just businesses have this very positive reinforcement that if they increase their price, people will pay the increased price. Like at some point, the market has to say no. And that's when they'll say, oh, inflation is not going down. But I know because of pandemic, Americans have a lot of savings and it's very easy to get credit and it's very easy to buy things. But at some point, Americans are going to have to be the ones to say, stop, I don't want to buy this. And that is what will eventually make inflation go down. Literally, that is it. Like people deciding, no, this is too expensive for me. But I don't see that happening. Or it's, I can't afford it because I now no longer have any money. But there's not, I urge Americans to be thinking before that they run out of money, like, hey, this is too much. Businesses, services, please, I will buy your service at this price because it is not worth that. But if we don't value money, and I guess it goes to, it's probably reinforced with how cheap and how easy credit is in the US. You know how much an average mortgage rate here in Mexico is for years and years?
Tell me, is it mostly variable or fixed? Like I know in Argentina, you can't get a fixed mortgage.
I guess it depends. You could probably negotiate.
Yeah, sure. Tell me.
But it's like 13%, 13%.
Now, right now, with
yeah. But that's like,
that's high.
It's common. You that's your mortgage on your house, 13%. And 10 years max.
That's
But in the US, 30 years and 5%. Crazy.
Yeah.
It's so cheap.
Yeah. Or even less than that. Yeah. So I sort of see it as like the primary consideration that I think about is the debt liability. So all the unpaid Social Security payments, the pension plans, the education, the credit card, the insurance, the commercial real estate, the military, the on and on and on, sovereign debt, all that stuff aggregated together to me is unprinted dollars that will be printed. And if they're not printed yet, we don't see the inflation in the prices and the CPI data, but that doesn't mean the debt's going away. In fact, it goes up because you have interest on that debt. So sooner or later, like that's going to come due. I think of this like one corollary I see that's very infrequently described is it can be very complicated to think about debt on a federal level or national level, country level. There's all these complicated terms that get thrown around, central banking. But if you think about it on an individual level, if you're in debt, you earn 50,000 a year and you're 100K in debt, you kind of can feel what that's like. It's like, okay, that's a really, really tough hill to climb out of, but it's possible I could do it. But if I'm 200,000, even when you're 1 year annual salary in debt, like you're talking about a 5 to 10 year time frame of living pretty frugally to get out of it. Now, if you live the other way, if you're like spending more, then you can see clearly like that's going to end in bankruptcy. Like there's no other way it can end if you're 1 year personal salary in debt and you're increasing your spending with no projection to increase your earning. And so we've never seen that happen. We've never seen like a large, in my lifetime, like a large company just completely default. The closest thing I can even remember is Greece. Maybe that was like 10 years ago, is like they had to sell off some land to basically pay off their debts. So I don't know.
I've seen it. I get your point, but America is not in a void. America lives in this place in space and time. And in this place in space and time, there's also other countries with equally shitty situations, if not shittier. And I don't know them all, but you as a consumer of the dollar are probably more likely to decide to buy dollar than any other currency. And just think of like even the Mexican peso and the high country risk. And it's appreciated against the dollar, like 20% in the last 8 months. But still, it's like Mexican peso is risky. There's a whole political situation here, and there's elections coming up, and I don't know what's going to happen. And okay, well, but that's Mexico, right? Then look at China. There's a dictatorship there, dude.
Can I ask you a little bit more on that? Yeah, you're from Mexico, living in Mexico. Mexico, I think, is 130 million people. Like it's a very large country. What do you see as both the most positive thing going for Mexico and then the most challenging negative part? And it's maybe specifically on its economic projection over the next 5 to 10.
I'm going to venture into an unknown territory, as I have. I'm not an expert in anything. But like in the short term, the thing that's very cool about Mexico, which I don't know, but I will tip my hat to the president of how he managed the whole COVID situation. But the price of the peso has gotten stronger, like incredibly stronger for the first time in like ever, like 20% stronger against the dollar, which I think is incredible, especially now where most countries are facing exactly the opposite problem because they all had to resort to printing money, the finance, the lockdown. So I think that's incredible. Yes, by the same token, and the other side of that coin, there's the president who's presumably going to try to. I don't think he's going to try to get reelected, but the risk of election meddling is like high right now, and there's precedent for very bad economic decisions where a lot of progress that had been made in fiscal reforms, electrical infrastructure reforms has been just destroyed. And every investor is second guessing their decision to bet in Mexico. So that's going to be a big challenge. And in a more cultural level, what I'm very excited about is it seems like Mexico is happening. It isn't the zeitgeist. It is something that we humans are doing right now. We're doing Mexico. And so I'm going to live in this part of town called La Condesa, which is, it's what you imagine every cultural melting pot looked like at any other point in history, whichever it was. It's everyone is moving here. Everyone is here. The restaurants are here. The artists are here. The entrepreneurs are here. Except you, but you're going to be here. Case in point. Right. I'm here.
Yeah.
And so that's very exciting.
Yeah. Fascinating. Well, I promised I would get you out of here in an hour. I really appreciate your time, Ruben. And this has been a blast. Congrats on all the progress. Are you writing online? Are you tweeting personally? We'll have all the links to the company in the show notes.
Man, I wish I wrote more. I'm always so invested in my writing that oftentimes I'm like, it's too much time. I'm like off to something else. And I write a lot internally. Like I spend a good time of my day writing a memo or a reason why that we should do this or this other thing. But I seldomly go on Twitter because it's like, man, so daunting.
Daunting. Yeah.
But
yeah. Well, I encourage you to put more thoughts out there. You have great ideas and you guys are working on really innovative stuff that affects a lot of people. So
thank you, Mike.
Come someday, man. Really appreciate you.
Well, you can follow me, Ruben GSP.
All right.
I'll maybe post something funny.
Bam. There it is. All right, buddy.
Bam. Thank you, Mike, for having me.
Take care.
Good conversation.
Sweet.